Let me ask you a simple question. If a war breaks out, oil spikes, inflation surges, and the market drops 30%, do you have a plan? Or are you just going to panic sell like everyone else? Because right now, headlines are screaming, Iran, Israel, oil, Trump, the Fed. It feels like a perfect storm, and I'm seeing way too many people getting whiplashed trying to trade their way through the chaos. That's a guaranteed way to lose money. Here's the truth no one wants to hear. Fear spikes faster than fundamentals break. The market loves to test your conviction, and the second you flinch, you lose, every time. In this video, I'm not going to predict how this crisis plays out, because prediction is gambling, preparation is strategy, and the best investors, the ones who keep compounding year after year, they don't chase headlines. They build frameworks that work in every scenario. So today, we're going to break down what smart money is actually doing right now. I'm going to show you how bear markets, war headlines, and panic cycles are actually opportunities if you understand the math behind them. And at the end, I'll share 3 positions I believe are worth watching right now. Not my entire portfolio, but a sample of the conviction-based moves I'm focused on in this environment. If you're someone who believes in conviction investing, in playing the long game, and in making decisions based on numbers instead of noise, this is the video you've been waiting for. Let's get into it. Let's start with the hard truth most investors ignore. The world has never been calm, and the stock market has never needed calm to create wealth. Over the past 30 years, we've had over 70 wars, 2 global recessions, a housing collapse, a tech bubble, a pandemic, and more political chaos than anyone can keep track of. And yet, over that same period, the Nasdaq went up 40 times. If you simply held the S&P 500, you made 7 times your money. No timing, no genius plays, just time in the market. This is what retail investors forget. They see a war headline or a Fed headline and think it's a warning. But every generation has thought their crisis was different. And every single time, the people who stayed invested came out stronger than the ones who flinched. Let me give you the numbers, not feelings. After the Gulf War, bull market. After 9/11, bull market. After the great financial crisis, bull market. Even after COVID, one of the fastest crashes in history, the market snapped back with one of the strongest runs we've ever seen. So if you're sitting there thinking, the market's holding up now, but this could all unravel fast, you're not alone. That's exactly the fear Wall Street feeds on. It doesn't need the market to crash. It just needs you to doubt what's already working. And when that doubt creeps in, most investors freeze, hesitate, or worse, sell strength right before it compounds. But the data is undeniable. Crisis is temporary. The recovery is what lasts. And if that's true, then every period of fear, even if the market hasn't crashed yet, becomes a window. A window most people miss while they're waiting for confirmation that never comes. Here's what most investors don't understand. Bull markets don't just recover, they dominate. Since 1932, the average bull market has lasted nearly 5 years and returned more than 170%. Meanwhile, bear markets, just 1.5 years long on average, with a total drawdown of around 35%. That's not even close. So let's be honest, the market gives you way more time to make money than to lose it. Yet most investors lock in losses during that short window of fear, then sit out the time that actually builds wealth. That's not strategy, that's hesitation disguised as caution. And even worse, the biggest gains often happen before the fear clears. Investors wait for clarity, but by the time they get it, the opportunity's gone. That's how the market punishes indecision. It doesn't need to crash to shake you out. All it needs is for you to second guess what's working. This is in theory. Over the last 6 months, while the headlines were filled with war fears, rate drama, and economic doubt, I stayed invested. No panic selling, no second guessing, just sticking to a system. And year to date, I'm currently up 32.76%, while the S&P 500 has barely moved. That's not a flex. That's what conviction looks like. Most people let fear run their portfolio, but if you zoom out, the data makes one thing brutally clear. Pain is temporary, growth is dominant. And in the long game, bull markets don't just recover, they absolutely crush. Fear is loud, but fear is also fast. When headlines hit, war, inflation, rate hikes, political chaos, markets react instantly. But here's the part most people don't understand. While fear shows up in a single day, returns show up over years. One is emotional, the other is exponential. Pull up a chart of any major market crash. It doesn't matter which one. The fear spike is sharp and obvious, but zoom out. The crash is a tiny red blip surrounded by years of compounding. That's the pattern, always has been. But fear doesn't just move markets. It hijacks investors. It convinces people to wait, to sit in cash for now, to wait for more clarity. But clarity doesn't come with a bell. By the time you feel safe, the market's already 20% higher, sometimes more. That's the trap. Fear hits fast, but it fades even faster. The media moves on, the market adjusts, but most people stay frozen, still reacting to the thing that already passed. That's why so many investors miss the recovery. They're looking in the rearview mirror while the next leg up has already started. And this is where long-term conviction wins, because the people who stop reacting, the ones who learn to expect short-term panic, they're the ones who actually make money during it. Not by predicting when it ends, but by holding quality while everyone else is selling noise. So when fear hits again, and it will, remember this: volatility is the price you pay for long-term wealth. It's never comfortable, but it's always temporary. There are two types of people in every market cycle: short-term traders and long-term operators. Short-term traders react. They chase headlines, try to front-run the Fed, play the oil spike, short tech, buy defense stocks, hedge their hedge, and convince themselves they're being tactical. But what they're really doing is guessing. They're just moving faster, not smarter. Operators do the opposite. They know the outcome of any single event is unknowable, but the range of outcomes is manageable. So instead of betting on what might happen next week, they build a strategy that works over the next 5 years, and then they stick to it. Let's apply that to what's happening right now. The Israel-Iran situation is tense. Crude oil could spike. Inflation could tick up. Rates could stay higher longer. Or none of that could happen. If you're a trader, every headline feels like a signal. If you're an operator, it's just noise. This is how institutions think. They run scenario models, not emotional reactions. They know when to stay hedged, when to reallocate, when to hold, not based on fear, based on planning. Most retail investors get caught trying to be clever, but clever rarely outperforms calm, because calm compounds. That's the difference between professional capital and panicked capital. One plays a strategy, the other plays a story. So ask yourself, are you building a portfolio that can handle volatility, or are you just hoping to avoid it? Because avoiding volatility is impossible, but building a system that wins through it, that's how real wealth is made. Technology is always the first casualty when fear hits the market. High beta, high valuation, easy to panic sell. That's why every time headlines get ugly, growth stocks get crushed first. But that's also exactly why they bounce back hardest. So is this a good time to invest in tech? Only if you like buying strength at a discount. 6 months ago, people said tech was too risky, rates were too high, inflation was sticky, and the market looked fragile. A lot of investors bailed. They said, I'll wait until things settle. I didn't, not because I'm a genius, but because I have a plan and I stick to it. I stayed in, and today I'm up over 30% year to date, while the S&P 500 is barely moving. That's not just a gain, that's 30% more capital I can now compound. And this is how you build a war chest, not by timing the market, but by positioning yourself when others are scared. Most people miss that run, and here's the brutal part. They're still waiting for a perfect entry that never comes. Let's talk fundamentals. The bear case is obvious. Rates, volatility, uncertainty. But the bull case, AI is scaling, cloud spending is growing, these businesses are getting stronger every quarter. They're more efficient, more profitable, and more essential than ever. So if your goal is to hold for 10 minutes, don't touch tech. But if you're playing the next decade, you want the stuff that drives the future, and that future is on sale when fear is in control. Smart investors aren't sitting on the sidelines. They're buying quality companies, the ones with real earnings, real moats, and real upside before the crowd wakes up. Let me walk you through exactly where I stand right now, because this isn't just theory, it's capital, it's conviction. My portfolio is already fully built out, and that includes Palantir. On that, I'm actually overweight. It's one of my highest conviction positions, and I'm not touching it here. Not adding, not trimming. When a company keeps executing and the thesis stays intact, sometimes the smartest move is to do nothing. Just let the compounding do the work. Now, let's talk about what I'm watching. 2 positions I may add to if volatility flares up. We've got SCHG and the QQQM. SCHG gives me high quality growth exposure without chasing hype. The QQQM is the long-term monster. It's not sexy, but it quietly gives me top-tier tech, innovation, and scalability, and it does it with low fees and tight tracking. And right now, neither is screaming buy the dip, but that's not the point. The point is I'm staying locked into names that get stronger every quarter. Not headlines, not predictions, just fundamentals and positioning. This is where investors get it wrong. They look for new picks every week. I'm not doing that. I'm building a portfolio that compounds, that survives stress tests, that scales with time. That's how you get ahead, not by making big swings, but by doubling down on what's working. So while others chase oil spikes or try to short every headline, I'm focused on the positions that actually build wealth. Not the flashiest tickers, not the trendiest trades, just the ones that will still matter 5 years from now. If you're still watching, it means you're serious. You're not here to panic, you're here to build. And here's the truth. Most people don't lose money in the market because of bad stocks. They lose because they can't hold through volatility. They have no system, they have no conviction. This is Sam. He's not guessing, he's not swinging for the fences. He's DCAing into high conviction positions even when the headlines say wait. Over the last month alone, just since early May, he's up over $25,000. Not because he caught the bottom, not because he timed the spike, because he stuck to a process when most people froze. That's how you build wealth, slowly, steadily, and with purpose. My Patreon isn't built for gamblers, it's built for operators. People who want a proven watch list that evolves with the market, real-time analysis when volatility hits, option strategies that create income without guessing, and a system designed to grow, protect, and compound capital. Most investors are reactive. They're waiting for perfect conditions that never show up. The ones who win, they act while everyone else is hesitating. The market doesn't wait, but if you're ready to move with clarity, the link's in the description. Let's get to work.